Hey everyone, I'm Sarah Grinelli. Welcome to the 12 Respond Show. This week, our guest is Donna Sowa Allard, a financial advisor. Donna, welcome to the show.
Thank you so much. I'm happy to be here.
Give us a little bit, some information on your background.
Oh, sure. So I'm a certified financial planner. I have an office in Lincoln, Rhode Island. In fact, our firm, Sowa Financial Group, has been around for, I think it's like 35 years now, started by my dad back in the early 90s. But I work with folks mostly who are either preparing for retirement or who are in retirement. So I help them plan for a successful at that successful stage of their life, and then also help them invest their money, use it as a tool to help meet their goals.
Awesome. I wanted to talk about prediction markets. It's been a hot
Mm.
topic lately. It's making a lot of headlines. For people who don't know, what are prediction markets?
Yeah, I think a lot of people might have heard about them for the first time at the most recent Super Bowl
Mm-hmm.
when there was a prediction market bet around Cardi B appearing as a guest in the halftime show. And then there was controversy about it. So I think that's a great way to kind of like enter this conversation. So prediction markets are binary. There is a yes or a no, and nothing in between in terms of whether you won something or not. So what you're purchasing is actually a contract, and the price that you pay for it has to do with the likelihood or the chance that something will occur. So a contract pays $1 if your bet wins. So if I said yes, Cardi B is going to appear at the Super Bowl, and at the time there was a 65% chance that she would, then I would have paid 65 cents. And if she did, I won, then I would have gotten 35 cents as my reward for that one contract. And you can buy multiple contracts to, essentially bet or invest, depending how you want to talk about it, more money. As the event gets closer, maybe there's more information available. You see the market moving in the public. And so now that 65-cent bet that I made, maybe more people think it's going to happen. And so now it's where people are buying it for 85 cents. Well, now that's a 20-cent difference. I could even sell my contract before the event happens and make the 20 cents. So that I don't know if that's a good explanation for our listeners, but it's all about the chance that something will happen, and then something happens or it doesn't. If it doesn't happen, I lose whatever I paid for it. So the most you can lose is the amount you paid for the contract. The most you can win is the difference between what you paid and $1 for each of those contracts.
And what
And
other
you can bet on anything.
things? Yeah, I was just
Yeah.
gonna ask what can you bet on? I've heard people, betting on the president's speeches and the words that he's going to say. Is it kind of pretty much anything you can bet on at this point?
Yeah, so these markets actually have a long history. If you go back to the 19th century, I believe they were originally started around presidential elections or political things. So betting on an outcome of who would be elected. And it's kind of interesting because one of the risks that goes along with it, right, is if I'm watching this market and over time I see that more bets or the chances are going up that something is going to happen, well, does that actually influence the outcome? Because if I see that the likelihood is that so and so is going to be elected, does that mean that people voting for the other candidate don't come out and vote, and therefore it's a self-fulfilling prophecy? So that's one very interesting, dynamic of how these things can work. But you can bet on things as big as presidential elections and things as small as, like you said, the number of times that the word tariff will be said or something like that. It also can lend to intricacies of sporting events, though sports betting is a separate thing. And things like I mentioned at the beginning of the show, who is going to show up at an event? Almost anything can be put in one of these designated contracts, and then you can purchase it on the CFTC market. So it is the commodity futures trading market where these exist.
And what's the difference between sports betting and betting in a prediction market? Because I know know nothing about
Yeah,
sports. I've
so
never bet on
there
sports, but maybe a prediction market, I might throw a little dollar or two in.
Yeah, so one big difference is how they are regulated. So I think that's a good way to start thinking about it is, and there are protections within these markets as well. So this is being regulated again, as I said, on the CFTC. It is where sports betting and such are regulated at the state level. So sports betting is legal in some states, but not in others, as you know.
Hmm.
There's also, rules around like market integrity. There's rules around reporting that these markets have to have on the commodities futures trading market. And there's rules around things like insider trading and fraud. Because as you can imagine, if you're betting on an event that may or may not happen, people may have inside information, which could be filtered through to the public. So those are some of the differences.
Hmm. And I can imagine if you're betting on something that you might already know might come true, it'll give you a leg up. Are there protections in place for these prediction markets when you're thinking of insider trading?
Yeah, so those predictions come in the form of regulation. So they are actually after the fact, but it comes in, the enforcement of, if they do find fraud or market manipulation. So think of like other financial crimes, how they can be prosecuted afterwards. So in the moment, no, there's not necessarily a protection in the moment, but they are, going to be prosecuted as financial crimes afterwards.
That's interesting. When people are looking at these prediction markets, should they be looking at these as financial investments, or is this something that should think of as sports betting that might be fun?
So, from my perspective, I would say I would look at it more like sports betting, which can be fun. I do appreciate the fact that there is a known downside to this. You're only putting at risk what you put into it, or what you pay for the contract. They're very short term in nature, and I like to think of investments as being more long term in nature. And when I think of investments, I think of, typically something where if I'm investing in a security or a company, this company probably has a product. It has forward-looking earnings that helps me determine what a good price is. And then reasonably, I want to invest for the long term. This is very quick. There is dynamic pricing that fluctuates, as I mentioned before. As you know, the sentiment around the event changes. Um, and like I said, it's very binary in nature. There's a yes or a no, and nothing really in between. So I feel personally that it is more like sports betting. However, it is regulated more like an investment because it's on the commodities future trading by the Commodities Future Trading Commission.
And do you see this becoming more of a legitimate tool in the future, kind of like the stock market?
Yeah, legitimate's a funny word. So it
Hmm.
is legitimate in that it is regulated, it is
Right.
legal, and it is real. However, I, at least at this point in time, I look at it as something that is more fun. This is not how you're going to plan your retirement. Actual investing is required for stuff like that.
Hmm. And what are some financial risks that people should think about if they're going to dump a bunch of money into one of these prediction markets?
Well, before I put any money into it, I would ask myself, can I afford to lose this money? So if this is not money that you can afford to lose, I would not put it into the prediction market. Um, does that make sense to you? I mean,
Yeah.
if something is such that simply who wins the election or or how many times a word is said determines whether something happens or not. There's nothing I can do to affect that, and there's not a whole lot of research I could do to go into it. So I would ask myself if I can afford to lose it. I do think that at least the way things like you mentioned, Polymarket and Kalshi, I think another big one is Predictit. The
Mm-hmm.
way these are being regulated, it seems fairly safe. At least from that perspective. I think that's okay, but I do not consider this something that has legs as a reasonable way to make long-term money. I think it's also worth noting that at this point, I believe Polymarket is still using crypto to purchase these contracts.
Hmm.
So if there's movement in the crypto market, is there opportunity for arbitrage? Like, does that affect um, your contract? These are all things to consider.
And if you're talking about this more in line, is sports betting something that can be fun? We know sports betting can also come with
Mhm.
a gambling problem. Do you foresee
Yeah,
maybe people could also be coming like having
absolutely.
an issue with these prediction markets?
100%. When something is so short term in nature, I believe that it gives you that adrenaline burst, so to speak, right? So if I place a bet and I get it right, well, does that incentivize me to place another bet for the possibility that I could get that right? So I do think that if you are someone who is inclined towards addiction, and addiction has many, many different ways of presenting itself, I'd be very careful around this. I'd be very careful around this.
For people who are watching this, what should they take away when they're thinking about prediction markets, maybe considering putting some money into these or not? What are your top tips for them?
Sure. I guess a top tip would be to make sure that you understand that the money that you're putting in can absolutely be lost. So to make sure that this is not the money that you need to pay for your child's education or to pay for your bills, right? This is to me, this feels like gambling, although it is not regulated like gambling. So I would treat it in a similar way. To set limits for yourself when it comes to money that you're putting into this, and know that when the contract is done, it is done. If you are investing in, a stock or in a mutual fund or an ETF in a sector, the market can fluctuate up and down. However, typically we make money over time. That's not the case in this. This is a short-term event-driven contract, and when it's over, it is over.
All right, great. We're going to head to break, but when we come back, I'm going to have you answer some common financial questions. We'll be right back. All right, welcome back. I'm going to bring back in Donna Sowa Allard. Donna, people are curious to know about saving for retirement. I know that's one of your strong suits when it comes to
My
advising
wheelhouse.
people. Yeah, it's in your wheelhouse. So tell me, for people who are just starting off with looking to save for retirement, where should they begin?
Yeah, so if you're just starting off as maybe a younger person or someone who isn't deep into the retirement planning, a great way is assuming that you have a 401k or some other sort of work-based savings program as a percentage of your income. That's how I would want to look at it. And ideally, and I say ideally because it's not possible for everyone, but ideally, I'd love to get to 15%. So if your employer has a 4% match, that would mean that you need to put away 11% to get to that ideal 15. Now, that said, just because you can't get that high doesn't mean that you should abandon savings altogether. So if you have the ability to, at the very least, get your employer match, start there. Most plans now have what's called an auto escalation feature, meaning once you start saving each year, you can click a box so that each year it will increase your savings rate by 1%. And so that's a very incremental and automated way for you to increase your savings over time. And it's done in a way that you're really not going to notice it a whole lot in your paycheck. So I like that as well for folks who are trying to get themselves to that ideal savings rate.
And if you are a little bit later in life considering retirement, where should you be putting your money when you're thinking of retirement too?
Yeah, again, don't be discouraged. The best time to start saving was when you started working, probably, and the next best time is today and tomorrow. So if you are trying to make up for lost time, you want to make every effort to max out your retirement savings. So getting to the maximum based on your age. If you don't have access through an employer program, but you are working, you can contribute to either a traditional or a Roth IRA based on your income. You can very easily open those up with any of the large brokerages online, or if you work with a financial advisor, they can help you. So the maximum that you can put in each year is lower, but it is better to start there. I'd put your money in at the beginning of the year if you can. That way it has the full year to be invested and hopefully be growing over that time frame. And again, don't be discouraged because you didn't start when you wanted to. Start now. Start now and do the maximum that you can. I'd also suggest that you automate your savings. So if you don't have the capacity to put in, if you're doing this independently and you're not putting in a lump sum at the beginning of the year, automate it so that it's going in monthly, similarly to the way it would happen if it was coming out of your paycheck going into a 401k or other plan at work.
And how, when you're thinking of retirement, how do you calculate inflation into that when you know it's a good time to finally retire, when you have enough in the bank, but then you're looking ahead till you still have to, you have expenses that you have to pay and that might go up?
Yeah, inflation affects everybody differently. If I own my home and I don't have a mortgage on it, inflation affects me very differently around my living expenses than it does if I'm renting and therefore will have my, rent going up on a regular basis. So it hits everyone differently. It's reasonable to use what the average is over time, which is right around 3%, recognizing that some areas will have higher inflation, like that around healthcare. We usually factor in a higher amount for that. There's a lot of financial planning software that can do this for you. So if you're working with an advisor, they can certainly factor it into the plan. And if you are not, there are some great financial calculators online. They will always factor in inflation because they know that, whatever you're paying for your groceries at 65 is probably not what you're going to be paying for your groceries at 87. So definitely want to factor that in. You can start with 3, and I wouldn't put anything below 3 though if you're doing this yourself.
Once you're considering retirement, you might be looking at, your credit card debt, to switch gears a little bit. If I have a
Mm.
boatload of debt, how do I balance saving for retirement and paying down my debt?
Yeah, so all that is not the same, but if we're talking about high interest debt like you would have on a credit card, which is, going to be anywhere from 22 to 27%, that is definitely going to be a hindrance. So I would, again, if I'm working and I get an employer match, I would focus on putting enough money away for retirement so that I am able to take advantage of that match from my employer. And then beyond that, I would throw all of my discretionary money against that high interest debt, because the interest being charged on that debt is guaranteed, while the return on your money in the short term is not necessarily. So again, put enough away to be getting your employer match, and then beyond that, focus on paying off that high interest debt.
I know we've talked about there are some different approaches you can go through if you're going to pay down debt. It was a snowball, the avalanche. Will you describe what those are?
Sure. So the two main ways to pay off debt is, one is mathematical, and it focuses on the interest rates. So if you have multiple debts at different interest rates, they each have their own minimum payment. So you focus on whatever the highest interest rate debt is, and make only minimum payments on everything else. So minimum payments on the others, and then everything else thrown against that highest interest rate debt. When that's paid off, you go to the next one. So that's the math way to do it. However, the other is the psychological way to do it. And there is benefit to seeing success. So what you would do there is pay off the smallest debt first. So you see it go away, and then you can throw all of the additional money at your other debts. So you pay minimum payments on everything except one, either being the smallest or the highest interest rate.
Great. And now, before we head to break, I do want to talk about your emergency savings. What should you
Mm.
have in emergency savings if you're planning for something to happen in the future?
Yeah, so the funny thing about emergencies is we don't plan for them to happen in the future, but we know that they will.
Plan
So,
with your
and it can be
savings.
things like it can be things you can actually plan for, like replacing your roof or new tires on your car, or it can be in a medical emergency where you suddenly have a big hospital bill, or maybe you have to take a little bit of time out of work. So, I like having 6 months of your expenses in some sort of cash account, whether it be a money market or a high interest savings account in the bank. So this is money you're not touching. I think it's worth noting, a fun vacation that your friends are suddenly taking is not an emergency. This is for things that would truly be a problem if they occurred, and you need to have the cash on hand so that you don't find yourself taking out high interest savings cards in order to pay for this emergency. So
So,
target 6 months of expenses.
6 months. In an ideal world, how do people set up their accounts? Because this could be overwhelming too. You're thinking of your savings, your
Mm.
retirement, your expenses. What does it really look like for the average person? What should they
Yeah,
have?
let's focus on those three things. So you have short-term accounts, and then you have long-term. The shortest term is your checking account. That's for cash flow. That's for paying all of your bills. That's for money that's going in and out on a regular basis. Then you have your emergency fund. This could be in the same location as your checking account. This would be a money market or a high yield savings account. This is money that you don't want at risk of the stock market, but it has to be there, when it is needed. And then you have your long term.
All right. Well, it looks like we're having a little bit of technical difficulties, so we're just going to head to a quick break. We'll be right back. All right, welcome back. When we left off, we had a little bit of technical difficulty. So, Donna, can you just re-explain about the three buckets that you were thinking that people should have?
Yeah, sorry about that. So it's your short-term savings and your long-term savings. So at the bank, that's where your short-term stuff is. That's your checking account for your cash flow needs, the bills that you're paying every day, and then your safety account, your emergency savings. That's in cash, either a high yield savings account or a money market. Beyond that, you have investments, which would be more for the long term. This could be your retirement account that's either with your employer or one that you have independently that you're managing yourself or with an advisor. And it can also be a brokerage account. So that would be a non-retirement investment account. So it's after tax, but that money is invested. It can be used for anything at any time, but any money that is exposed to risk, meaning in the stock market, you want to have a longer time frame on that. So more than 5 years, closer to 10 years.
Okay, great. I want to switch gears to talk about taxes because we're in the tax filing season
Mm.
now. What should people do if they're looking to file their taxes, but they have investment accounts?
Yeah, so sometimes custodians can take a little while to get the 1099s out to you. So make sure that you have all of your 1099s for your retirement accounts that are active and any other brokerage accounts. Your bank accounts will send you a 1099. You need to collect your mortgage statement if you have one, and any documentation of charitable donations you've made. There are many other forms you may need, but those are the most common ones that I see. Have them together, have them in a digital form if possible, because it makes it a lot easier to get it into either TurboTax or into the portal for your tax preparer. You want to make sure that you're not doing it at the last minute if you're relying on someone else to help you file, because again, they are going to have to help you file. And hopefully you've been doing some planning throughout the year so you are either on track in terms of making estimated payments, or you're well aware of what you're going to owe come April 15th.
If people have filed their taxes, we know there are some nice early birds or some people who just
Mhm.
get it done. How can they look forward to the following year and plan ahead?
Well, if you've already done this, then you know that you either hit the nail on the head or you didn't in terms of paying taxes last year. Did you withhold too much and get a big return? I don't love that. I know some people love to treat paying taxes as some sort of like forced savings account, but I have no desire to give the government an interest-free loan by withholding my taxes throughout the year. I can do so much better. So if you're getting too much back in a return, you might want to decrease your withholdings. If you found that you did not withhold enough, you're going to want to adjust your estimated payments throughout the year or the amount that is being withheld from your paycheck to accommodate for that. Now, if you work in the gig economy or you're a contractor of some sort and you are not a W-2 employee, you are responsible for your own taxes. It is not just your responsibility to pay your taxes, it is your responsibility to pay them on time. And on time means on a quarterly basis throughout the year. So if you are unsure about this, if you missed the mark this year, I would highly suggest you discuss it with a tax preparer so they can help you do better for next year so you don't find yourself paying any penalties. There's an interest rate that is charged as a penalty. And I believe after April of this year, it's going to be 6%, which is down from 7%. However, that's way up from the 3% that it was, back in 2021. So we don't want to be paying interest unnecessarily. We don't want to be letting our money sit with the government unnecessarily. Finding that sweet spot does take some planning throughout the year.
All right, Donna, thank you so much for joining us. You gave a lot of great advice and tips. I really appreciate it.
Thanks for having me.